and say, welcome, glad to have you all from home. Some of you, I think, are probably at an office as well. So if you happen to make your way in the office today, congratulations on that as well. So topic today is, I'm Dave Parker. I'm your host and moderator, and I'm going to keep hitting the admit button as we go. So if you hear that funny sound, that's what that is. And I'm going to take a few minutes to walk you through our agenda and make a quick thank you. And then we'll get off to the topic because we've got about an hour and we want to make sure we have time for your questions, most importantly, at the end. So I'll do some quick introductions to the speakers. We're going to talk about choosing your own adventure as far as both as an angel and as a founder. Which direction do you want to go based on what your options are that are currently available? Talk about building a market map and what the options are to see the best potential buyers in the exit scenario, whether that's private equity or a strategic. Current kind of state of valuation in terms, and a little bit about the due diligence process, walk you through a couple of case studies, and then talk about business development as a process. And as you have time to prepare for an exit, getting your best enterprise value is really based on, do you have an upmarket buyer that you really can map to? So we're going to go through that and then some Q&A. First, I want to thank with Alliance of Angels for putting this on and doing the invitation, and EGen. So with that, EGen, I'm going to hand it over to you.
Hey, thank you very much. Thanks, Dave and Mark, for hosting and running this session. Really appreciate it. My name is EJ, I run the Alliance of Angels. It's an angel group here in Seattle. There's 140 angels in our organization. Every year we put about 10 million into 20 companies. Most companies that are fundraising from us, they're looking for a total of between $500,000 and 1.5 million. And our typical check size is in the range of 250 to 500. Right? We are a sector agnostic investor, even though roughly about half of our deals are IT, about a quarter are consumer, the rest are life sciences, hardware, energy, etc. And we are also a stage agnostic investor. It doesn't matter how early your company is, we're always welcome to engage and have a chat with us. Right? Our hard filter is that we only invest in companies that are headquartered in the Pacific Northwest. Right. Dave, could you move to the next slide, please?
You bet.
Yeah, so lots of folks have asked whether or not angels are investing, given the current economic climate. And the truth is that the Alliance of Angels, as well as lots of other angels and groups that I'm aware of, have probably made more investments since February than they have comparatively to the past few months. So we are very much open for business. We've done lots of new investments. And if you are currently fundraising and you're looking for folks to partner with, we would love to hear from you. Feel free to send me an email, which is right at the bottom. My email is at the bottom of this slide. So with that, I better stop talking, right, and hand over the control of the workshop back to Dave and Mark. Thank you.
Yeah, absolutely. It's a pleasure, and thanks for the invite and hosting with us today. So I wanted to make a quick introduction. Gary, actually, I'll start with you from K&L Gates.
Well, thanks, Dave. I'm a partner with K&L Gates in Seattle. We have been affiliated with the Alliance of Angels since the beginning of the Alliance of Angels 20 plus years ago, and I work with a whole range of emerging growth companies from startup mode to exit mode, and so that's my perspective that I bring to the table is understanding the issues at various stages of organizations maturation, and then trying to anticipate what the issues are going to be at the exit, and hopefully avoiding the problems that I've seen come up in those situations.
I'm sure there's some good stories there. Mark, I'm going to hand it to you.
Yeah, hi, Mark Upson. I'm a member of AOA. I have an M&A advisory firm called NextPath. Prior to NextPath, I actually was a serial CEO selling my own companies, and then also did private equity, so I was buying companies. So I know that side of it as well. So our focus is on business-to-business SaaS companies in the Northwest.
And I'm Dave Parker, so 5-time founder, sold 3, closed 2. So, which is decent batting odds, but never a home run or a grand slam. They've all been singles. and then had a chance to work with Startup Weekend for a couple of years and run global programs there. So definitely spend my time between finishing a book on startups and being a community builder and really helping founders get a great exit. So with that, let me transition to the next one here, which is really like, Gary and Mark, what are you guys seeing for the elephant in the room? I mean, Eugene talked about investments are still happening. What are you guys seeing on the market conditions for valuations and getting deals closed?
I'll go first. So we're actually seeing it's all sector dependent right now. I mean, we're in the midst of a close process with actually our third recent AOA close. If you're in a sector that's seeing positive, I hate to say positive impact, but you're actually seeing neutral to positive impact from what's going on right now, then it's very busy at the moment. There's a lot of VC funds that are actually starting, fresh funds that are starting right now. People are looking at it as an ability to invest with knowledge of what they think, a better knowledge of what's going ahead and kind of where to kind of not invest in the near term till things shake out. So I think with that, we're seeing actually a great deal of activity. Haven't seen valuations go down dramatically yet. There has been some pressure, and I think the VCs were actually hoping for a little more pressure so they can get some better deals. But they're more than willing to make investments right now.
Gary, what would you add?
Yeah, I agree with everything Mark said. I'd say we're in a little bit of an adjustment period in terms of valuations. The buyers and the sellers, whenever you have, a severe market disruption like we just went through, and similar to what happened in 2008 and 2001, 2002, there's a period of adjustment in terms of what the valuation expectations are between buyers and sellers, and whether or not that's an investor or someone who's acquiring the entire company. The relative leverage and bargaining power kind of shifts a little bit. It becomes more of a buyer's market than a seller's market. And so, in those situations, the valuations tend to drift down. And until the seller's expectations adjust, there's a little bit of a chill on M&A activity. You don't see people, reaching out or agreeing on a transaction value until there's a little bit of an adjustment period that we go through. But Mark rightly identified there's a lot of businesses that are actually benefiting and prospering right now, and so their valuations are certainly increasing, and the investment in those types of companies are proceeding, probably faster than what they would have seen, absent the disruption. So, there's a pretty wide degree of variability of impact that you see out there.
Yeah, and I'd just add, I think the one that Mark and I are working on right now, I think we see companies that have some massive tailwinds and some companies that have massive tailwinds and not a lot in between. But private equity still has cash on the balance sheet, and they're still looking for deals. And we're seeing a little bit of slowdown in closing. I think as everybody kind of waits and see what happens on a couple of deals we've been watching. But yeah, a little bit of slowdown. So I think for the audience, one of the big questions is, if you're a founder or an angel, like where do you want to go with this? Because we're definitely in the new normal. So Mark, I just wanted to hand it back to you about like, what are my choices? Choose your own adventure. How do I make those decisions as a founder? I know you've sat in that chair too.
Well, it really is what your long-term plan is. And we really like to work with founders on kind of this fork in the road. And that usually if you're fundable, because you may have very active interest, term sheets, so forth coming in. You've got a good growth rate. You're in a market that's still very active. So, but it could be that personally you and the team have been in it for a while, and you're thinking, well, I can exit now and get a great return, or I can go another 3 to 5 years. So that's really a kind of a personal decision, investor decision to make it. But it's really important to kind of think through that. We do a lot of cases where we're running a dual path, but we're doing that because the firm usually is more interested in exiting. But if they don't exit, they want to move ahead and they need funding to go for it. So I think it's a good time to kind of reflect and decide your 3 to 5 year plan. And then based on that, that drives the next set of decisions that we'll talk about.
Great. So my options here, as I look to exit, especially now, strategic acquirers and private equity firms and aggregators, what's kind of the state of who do I think about as I'm thinking about exiting along that one, Mark?
Yeah, well, the key thing for strategic, and you know, we've got one of these going right now where if they can fill a product gap quickly, that makes it interesting for them, and they'll pay a multiple on a smaller company revenue, so make it a strong relative exit. But it typically there needs to be a relationship there. There needs to be either integrations or where you've gone to market together. There needs to be some trust building that's going on, and some validation, really. So typically, if somebody's buying you and you're under 10 million in revenue, they're not really buying you for accretive revenue. They're buying you for potential. What is the business case potential if they bring you in, take you to their install base? So depending on where you are in business development, we're going to talk quite a bit about that later on. You may need to do work to kind of really get to the strategic buyers, get a relationship going well ahead of any type of process or M&A discussion. The PE firms are actually very different. PE firms are either buying to supplement a strategic that they bought, which is actually very active right now, which actually is good. Or they're looking for more of the financially accretive acquisition, typically at least for SaaS firms, 3 to 5 million in revenue, and they're looking for a good growth rate and some level of profitability or break even or a path to profitability. But they can move very quickly. I mean, we've seen these move within 30 to 60 days from start to actually term sheet and move into closing, based on the right fit and hitting their criteria. But they're all financial criteria based for the most part in terms of their decision. So you can roll them into the process if you meet the basic criteria laid out.
Yeah, the only thing I'd add here is that I think that if you look at valuation impact on a strategic, the private equity is doing the work on the front end to make sure that they know your valuation, they've run the numbers, and they're very sensitive, much more sensitive valuation than strategics are, for sure.
Yeah, and I would just add, overlaying this on sort of the current market is, a lot of the strategics now are going to be dealing with, disruptions in their business. So they're going to be, I think, less focused on, the strategic opportunities. And as an example, I've got a client that got a large investment from Delta in their last funding round, and they were doing a big pilot implementation with Delta, and Delta lost almost $6 billion last quarter, so they're probably not going to be looking at any acquisitions for a little while. And then on the PE side, I think what we're going to see relatively soon, if it hasn't already started, is there's going to be a lot of opportunistic buying that's going to start driving the market where, good businesses have been sort of weakened financially, and PE is going to step in and, try to take advantage of that, or, companies that need funding that otherwise wouldn't have, the PE firms are going to start to fill that void.
Yeah, definitely some bottom feeder activity there too. I think one of the big questions for founders and angels is since there's not really a mark to market, is how do I value my company? What's it worth and what can I sell it for? So Mark, I know this is a question you get a ton as we talk to early stage companies. You want to fill in that, how should founders and angels be thinking about this process?
Yeah, and just one thing I'll put out up front is that people tend to hear about the 20x or 30x or 40, the huge returns, but I mean, it's very dependent on your situation. Let's jump to the next slide, Dave, because if you look at it, typically, if you see the public company multiple, so say you're in supply chain and the public company multiple is 7.3, well, you're not necessarily going to automatically get that because you're a private company, you're going to get discounted out of the gate. And then there's some factors that can help you or hurt you. Growth rate is a huge one. Being break even or very close to break even is really big, because then you can bring private equity into the mix. Market size, your how sticky is your customer base. That all does an adjustment in terms of your marketability and what your actual exit rate will be. And once again, your size makes a huge difference in the multiple. So if you're doing $1 million to $2 million in revenue, there's a lot more latitude to get a relatively large valuation multiple, for you, just because you're fitting the business case of the strategic, or you really fit the private equity, the category really well. But there's a lot of different factors to go into it. But clearly, the things that get you funded are also the things that get you bought at a high multiple. Growth rate, big market, and sticky customers.
So speak for a minute just about the difference between my last post-money value, what my pre-money would be on venture, and is my price going to be similar if I sell? Because I think that's a common misconception.
Yeah, and once again, it's kind of sector dependent, but in general, investors will can give you a better valuation, but you're going to have to grow into that valuation, over a period of time for post-money valuation, as opposed to you can exit. You may not be able to exit at the same post-money or pre-money you're seeing from the VCs, but you should be able to exit it close to that. I mean, that is a market data point for you. But strategics and PE firms aren't going to outbid VCs usually, for a company.
So price is one thing, but deal structures blow up a lot of deals, Gary. So talk a little bit about the deal structure, and we can bounce back and forth on employee packages as well, because what people get when they come out of it is going to matter as well as the sale price.
Yeah, well, the tax implications of the deal are oftentimes really important and not the first thing that people think about. So that would be the first thing I would say, is make sure from the outset you think about what's the most advantageous tax structure, from a seller's perspective. If you sell assets, you're paying tax. If you have a corporation, you pay tax at the corporate level, and then you pay tax again when that money gets distributed to the stockholders. So in that situation, it's a lot better to do a share purchase or a merger where you're basically selling your stock that hopefully qualifies for capital gains. So that's sort of the biggest, influencer. Then the other is, as you note up here, is earnouts and, different components of a deal that's subject to variability, which, a lot of times, they may sound good on the front end, but, it's pretty dicey on whether or not you achieve them, especially when, you're giving up sort of the levers of control to drive the business to achieve whatever the requirements are to hit the earnout. So I'd say more times than not in deals where there's some type of an earnout, it's the vast minority of the deals where that full earnout is actually earned. And a lot of times it's only a relatively small percentage. So try, as a seller, you want to try to get as much as you can up front. Escrows is an interesting topic because that's changing a little bit now, especially, in companies where there's PE investment. Mm-hmm. A lot of times these escrows are being phased out, and what's replacing it is reps and warranties insurance. So you have an insurer that comes in that provides an insurance policy where the escrow would have been in prior years, and that's, I think, been a pretty big recent trend in deals right now. And the cost of that insurance is going down, and so rather than put 10 or 20% of your deal proceeds in escrow, you might pay 2% of the transaction proceeds to buy a insurance policy, and then you put, that, 8 to 18% into your pocket as opposed to into the escrow. So that's, I think, a nice trend from from the seller's perspective that, is a recent development.
I'm going to take a quick note here, Mark, and come back in just a sec and let people know you can text me questions if you'd like. I'm going to open it up for a few questions here. The price and deal terms are a huge issue before we kind of move into the mechanics and the due diligence process and things like that. So feel free to hit me on chat. You can hit me direct or hit me in the group. Either way is fine. And we'll start to do that here in a second. But Mark, I wanted to come back to key employee packages, because it's not just the sale price and who's there. You've got some key folks you want to retain in the company afterwards. And I just want to take a minute and talk about that, because that's one of the considerations as well.
Yeah, because you typically have it where most deals of lower middle market, there's going to be, the offer is going to include what goes to shareholders and then what goes to key employees for retention. And a lot of times that can be 2-year packages, 3-year packages. I've even seen 4-year packages, which is extreme, to try to incent and retain the team. Once again, as Gary mentioned, earnouts can be problematic just because you tend to lose control when you get acquired by a larger company. So focusing in on trying to keep it retention based or some more reasonable set of milestones for the payouts. But a key thing is for us is to work with the execs of the company being acquired on how to negotiate their packages at the same time. And then there's always a little bit of tension between the investors and the founders in terms of who's getting what and who's getting what percentage. And that's all part of kind of working it out. The acquirer wants to keep the people and would prefer to actually give more to the employees over time than what they're giving investors in a lot of cases. So, but that's just something you've got to work out. One other comment on the escrow. I think, and Gary, that the trend on insurance, I think, is really interesting because investors want to get paid and they want to de-risk it. But we find for the most part, escrow usually doesn't get hit, and you can put limits on it and so forth. So, but you are tying up the money. It's a source of contention. But fortunately, a lot of times the escrow makes it through, but you're waiting, up to 2 years for your escrow. So.
Yep.
Great. Well, a couple notes here, and I'm going to open it up for some questions. So you can unmute yourself, or you can chat me the note, or chat me the question in direct on the chat. Yes, the slides are available. Yes, the recording will be available, and you'll get a survey from AOA after the event's over, and we'll use that to as well. So, Mark, question from David here. It says, question is about how do you value a company that doesn't fit the typical EBITDA revenue model? I run a company that's developed a new business model in a relatively unknown sector, carbon markets. How do you value a company when there's no equivalent in the market and little sector knowledge?
Yeah, it becomes then what's the business case for a potential acquirer? Who would benefit from the technology you're developing? That sector, what's the addressable market of the sector? So you can still look at the key things around your growth rates. I mean, they still apply. You don't have to have a direct comp to say, no, companies growing this fast into this size of a market. What type of differentiation do you have? What patent protection do you have? You can work to come up with a valuation on it based on opportunity, really opportunity and business case.
Yeah, and I would just add that that's where people like Mark add a ton of value to the transaction, because they help you sort of make that case and build that value model to the different potential acquirers, so that they can see and look at a company and come up with a valuation to the particular acquirer and why it can support a different valuation. And having someone that can help you explain that and understands how the buyer looks at it, is very valuable when you're in that type of an exit transaction where you don't have a lot of comps or other traditional metrics that you can point to.
Yeah, I think that it's very similar to early stage venture, right? If it's a gigantic market and you have a unique opportunity, then you're getting valued on the how big is the opportunity. The more mature the company becomes, the more it's data driven on sales and sales growth, and you run your sales growth and profitability, and so that's where profitability versus strategic will have a big variance. Paul asked the question here too about moving to market rate salaries post deal and equity components post deal. So I know, Mark, we're working on one of those now. Do you want to comment on that?
Yeah, I mean, almost invariably, the founders and team are working under market. So there's both the move to market, base market, bonus compensation, and then have the retention be above and beyond that, as a separate element, for it. So it's getting these in the different buckets, and then clearly benefits and so forth tend to be better usually at the acquire. But this is all negotiable, going in, and you want to negotiate it before the deal is done. And usually they want people signing contracts anyways. So this is all part of the making sure you're asking for the right things before the deal is signed.
So I think one other thing to just add there is, if you think about it from the founder's perspective here for a minute, because that's definitely the chair that I'm used to sitting in, is we're going to get a sale price, we're going to take care of the shareholders on that process, and then we're going to highlight who the key employees are. We're going to move them to market rates. We're either going to create a bonus plan or comp plan, and it may or may not include equity. So some of these companies will be private equity owned, and there's not a big pool, right? So they have an LLC, they may have a phantom stock plan, but all of those are considerations that you need to negotiate all at one time. So I would say if you're a founder listening in, think of this as the entire package, because once you've done the transaction, the investors have a price, and you have a price, an incentive, an escrow, an earnout, and potentially a bonus. And you have to put all those things together in a bundle without taking any value away from your shareholders. Somebody asked a question here as well, guys, about drill down on escrow timelines. The money being held for 2 years is mentioned. Is this common? So Gary, what are you seeing from market for escrow timelines?
Generally, the rule of thumb is 12 months. Buyers will often try to have a longer period, 18 months, 24. I don't typically see it longer than 24. And sometimes, if you have more than a year, you'll have kind of a staged release. So after 12 months, they might release half of it and then, hold the rest for a certain portion after that. And then it can also be driven by whether or not they've got any specific concerns that they identified as part of their due diligence. So if there's like a potential claim that's out there, that might also tie to the length of an escrow period. But I'd say the rule of thumb is generally, 12 months is kind of the starting point.
Yeah, and it may be, and if it does go to 2 years, it could be a 12-month for part and another 12 months for the other part.
Yeah.
All right, I'm gonna continue on here. Please do send me more questions as we go, and we'll get to some more questions at the end. But I want to touch on some mechanics. I have a due diligence checklist for you that there's a link to both on this slide and the summary slides, which just gives you the basics of what should be in your data room. And this is just good corporate hygiene. And typically it's like having the bylaws that got filed for your incorporation with the state. No one ever looks at it until you go to sell. And then you have a whole bunch of things you need to know, like what notification do we have to give somebody? And what are the rules of those notifications? All those are driven by your corporate docs. So I would just encourage you to know that you're going to need to set aside some time to do that. We have a promo code for you for OneHub at the end that you can use for a 6-month free version of it. The difference between setting up a data room and something like Dropbox and a OneHub is that every document's data watermarked. So if Dave prints it out and it gets out in the public, you know where it came from. So just know it's a little bit more secure than a standard kind of shared folder system. These are some examples of what those are, but some big ones. So PIA agreements with all of your employees, everybody who's ever touched the code, as an example, we'll want to have release agreements. And we just want to have a good place documented for that. I'm not going to bore you with more details. It's a checklist. Checklists are useful, but it just means some time you have to set aside as a founder. Let's talk about deal breakers and blockers. And I know, Gary, both you and Mark have had some where you're like, oh my God, that was horrible. So just a couple of quick stories here and I'll keep moving to the case studies.
Yeah, Mark, you go ahead first.
Yeah, well, inflated exit expectations, particularly the more, and I've had, VC, I've, very involved with a lot of VC folks, but the inflated expectations of what they think the company is worth and what they're willing to take for the company, the market decides that. I mean, as it turns out. So if, and there's times in which a company, just because of how much money they've taken in or dynamics, they don't want to take a deal that's actually been gone through the right business development process. You've gone through the logical buyers, and then they don't take it. And then for whatever happens, on their business side or the market side or whatever, they're now stuck. And so I think a really important thing is making sure the board and the key investors and the founders agree on a range of expectations of, market range, not just I want to sell this for 200 million, but no. So what's the range? What would be a exit where everybody says, well, it's not the perfect exit, but it's a reasonable exit. And then have yes, this is the dream exit as well. But have a range, and unfortunately, a lot of times this doesn't get worked out before the offers start coming in, and it becomes very difficult to negotiate when there's no range to negotiate within. It's incredibly important. And there's I know a number of companies that went out and then came back and said, well, I should have taken it 2 years ago, because I had an offer 2 years ago. The corporate hygiene Dave talked about, that's just something that'll bite you in a financing as well as in an exit. And then if there's, you want to get the deals done, this kind of goes along with the inflated expectations, is getting it done quickly because stuff can go wrong. And we've had stuff happen. We had one where we had an offer. The company ended up making an offer on another company also. And then because things drug out, they ended up buying the other company first, and then some other stuff happened and the deal got delayed. So once you're moving, time is your enemy. You want to get it done. And you cannot have surprises in the diligence before the signing the definitive agreement. You've got to kind of have a plan to deal with bad news or something that you hasn't come out yet. It needs to come out sooner, because otherwise it's going to come out after the deal. You could hit escrow. You could hit all kinds of bad things at that point. So, Gary, would you agree with that?
Oh, absolutely. And I've seen, examples of all of these types of problems and issues that come up. One of the most frequent issues that I see is, and especially where a private equity type company is the acquirer, is, if you get in and you strike a deal based on, your next 12-month projections, and for some reason the company takes the eye off the ball, or there's some sort of disruption in the market, and all of a sudden you're not going to meet those projections. Boy, those private equity firms love to sort of go back and renegotiate the deals, and they've kind of got you over a barrel once you've started down the road with them, and so you're basically forced to sort of accept, some renegotiated deal terms at the last minute if you're not managing the business while you're sort of managing the deal process. So that's, I think, one of the biggest issues that I see come up. And the other thing I saw, and Mark, you talked about it, is the valuation expectations. I saw a company that got a very good offer from a public company that was half cash, half stock. the founder had sort of an inflated expectation of valuation, was negotiating and nickel and diming, and so the buyer walked away. And that stock, in hindsight, doubled or tripled in the next year, and it would have been a great deal. And they were forced to come back and do another deal, at actually a lower price, all cash. So, that really worked out badly just because the founder was trying to drive, an inflated deal expectation. And conversely, I worked with Clarisonic when they did their exit, and their board was one of the best boards I've seen. They sat around and, years in advance of the exit, they talked about what would be a reasonable valuation on an exit and who are the right buyers and how do they sort of, set up the environment for having multiple people involved in an exit. And they ended up getting 2 or 3x what they thought was a reasonable valuation because they had multiple people and a little bit of a bidding war. And so they were very sort of intentional and talked about it in advance. And so that's what I would hold out as one of the best practices that companies can do.
Yeah, the only thing I'd add from the founder perspective is just don't wait too long. I mean, if your runway becomes short and the buyer knows it, you're at risk, right? So don't wait until you're 90 days away from being out of cash and you're deciding to run a dual process of fundraising or selling. You're risking your enterprise value and you're risking your return. And from a founder's perspective, this is usually your biggest singular asset and maybe your only asset. So the idea of not landing the deal is kind of tragic, right? So you want to be careful you don't wait to the end. Mark, let's hit a couple case studies for strategic and for private equity real quick, and then we'll go into biz dev as a service and go back to Q&A.
Yeah, and these are both AOA companies that talking about here. So first one, dual process. So smaller revenue company, getting ready to do their A round, but they were fitting a market gap, a very, a market that we could see was going to be growing fairly quickly. So we immediately had one company interested in making an offer, but then we kind of brought everyone in a 30-day process to work around that anchor bidder. Ended up the best exit wasn't the original anchor bidder. It actually was one of the ones who bid it up, and we got almost 100% premium over the initial bid by running it. But that was filling a market gap. We got a big multiple on revenue as a result of it. But this is just a key one where the founders and team were able to get a really good personal exit. Investors got a really good exit just because of the timing and the level of strategic interest in them early on. So the next one is a company that was a little longer, still in high growth mode, but it was profitable. This is one that actually Gary we worked on, but we actually did a very methodical way of going out and starting to build the exit pool, build relationships, drip market the private equity firms. And through it, we ended up actually, private equity came in very aggressive with an offer for us, kept the company operating as is. The CEO was able to exit, which he wanted to do anyways. And we got over an 8x multiple from a really good private equity firm. So very successful. And that process from start to finish was 9 months. And this is starting out with no relationships, no private equity relationships with this particular company, and got them to a great exit in 9 months.
So I think that's part of the process questions. And I know somebody asked that, do you guys do consulting on it? And the answer is yes. Mark and I work together, and obviously Gary and law firms help out on the process, but more about how do you do the process if you don't need help, or how you should be thinking about the process, whether you use us or somebody else. So Mark, speak to, I know BizDev as a process is something you're a huge fan of.
Yeah, and I did this with my companies back when we were building out to try to get the best exit. And part of it was as a small company, a lot of times you don't have a business development VP or an exec. So the CEO ends up doing this on the side of their desk. They want their sales guy out selling, but you really got to do a very thought out view of what's the market map of potential partners / acquirers, and then look at how you can go to market together and build a business case, because it's all about the business case when it comes down to it. So if you can start and then work through it, you'll have some that lean in and you start to work with and you start to go to market, and then it becomes a very natural exit. At some point, they're either going to want to resell your software, or they want to come back in and say, hey, we're open to doing acquisition. Are you interested? And then it's just a much better conversation to have. Going out and running a process where you're going out cold and creating the book, as investment bankers have classically called it, and calling 40 companies is a terrible way to get the best valuation for your company. So you really got to do this work up front. And if you do it correctly, you actually will build your revenue stream, which will build your valuation, but it de-risks it for the acquirer. So they're fine to kind of actually give you a higher number if you're taking risk out of the equation. You look at some of the large folks doing acquisitions, that de-risking process is incredibly important, and they're happy to pay more, for it. And then out of this, you get that anchor bidder. And if, with the anchor bidder that's within your valuation range, all of a sudden now you're playing with house money, and we can actually work and go out and get other bidders and then negotiate the best possible exit in terms, out of it. So private equity, as we talked about earlier, is a little different. Basically, you want to drip market private equity firms if you're fitting their profile. I mean, you're going to need to either match up with some company in their portfolio if you're not profitable, but if you're break even or slightly profitable, you can start to drip out and just let them know, and they'll start reaching out to you at some point too, a lot of them. But there's certain firms that are much more interesting than other firms. There's a whole class of PE firms that do not pay more than 1 times revenue. And then we've had some that pay 10 times revenue and more. So on the private equity side, they can move pretty fast, overall. And it's all about having that information that Dave talked about earlier, having your data room ready so they can jump in and do their magic on their side to come up with their offer.
And one other thing I just add here, Mark, is I think the dirty little secret in this industry as a whole, having come to it from a founder perspective, is you're not necessarily going to choose the advisor who gives you the biggest price. Like, that's a great ego boost to you as a founder. You're like, these guys said we could get 80. And, I know you're very super pragmatic about, like, that's just not going to happen, right? And the difference between, do you want an ego boost or do you want to land some cash in your account at the end of the day and get a reasonable and a fair price? And I've just seen a lot of deals. I know I'm on the board of one that you and I didn't do, that didn't close last year. And when they chose the bankers, because I was conflicted out, by the way, they chose the bankers and I looked at the price. I'm like, nah, that's not going to happen. Like, I wish it would, but I know it's not. So just know that that's kind of the dirty little secret of the industry.
Yeah, right, and I would just add real quick, Dave, that's where, guys like you and Mark add the value is, a seller, most companies that I've worked with, when they look to a sale, they understand their business and they have a lens from inside looking out. What you and Mark bring to the table is you have that lens from the purchaser's perspective and how they see the business looking in, and then explaining that to the seller, and then explaining how the buyer is going to value the business. That's where the key is, and that's how you should evaluate, your advisor, someone who can make that compelling case and explain that to you as a seller.
Great. Thanks. I'm going to launch a poll here. I'm going to open it up for questions, so feel free to come off mic if you'd like, or feel free to text it in if you want to do it privately or publicly. It's both are fine. So feel free to add the poll information. And I'm also going to click forward to just a list of resources here for you. Contact information for both Mark and I, as well as Gary. I'll send this out and we'll get it posted from AOA as well as on Next Path Advisors and DK Parker on my blog for startups. But you know, there's some resources there as far as like, here's the due diligence checklist. I also do a weekly email reading list through Startup Digest on prepping for exit, a founder's perspective, because I definitely bring a founder's perspective to it rather than a investment banker perspective to it. Elizabeth asks, that's just a thank you. Never mind, I won't say what she's asking. Other questions? Yeah, Caitlin, go for it.
So we work in the medtech healthcare space. And so we often see companies where the strategic wants to get involved really early on and wants to be an early investor and wants to be on the board and wants to have information rights and kind of wants to be in really early. And some companies we've worked with really like that and think it makes it better for the exit. Other companies want to keep them as far away as possible and are worried about that for an exit. What's your role? What's your view on the role of strategics pre-exit discussions that can impact how the exit goes?
Mark, you want to take that one?
Yeah, I think I'd be very careful to have them as an investor, but to have them on your advisory board or have them as someone you're going to market with, you know, really extremely valuable. I'll tell, I won't call it a horror story, but I had a situation where I actually had a strategic come in, dying to come in and invest in a round that was already priced by VC, and they were talking about how they were going to take us to market and all of that, and it never happened. It was actually a distraction. And now we had them on our board, through for the next 4 years, as we went through it. And so you don't want to give them any control, and you don't want to scare away other potential partners. So that's why, an advisory board, and usually it's an individual that you're keying in on your advisory board from that firm, as opposed to the firm itself. And then that individual can help you, give you advice. And you can give them shares, give them options. And then also, if it makes sense for you to go to market together, that's great. I'd be very hesitant to give them any level of control or even take their investment, early on.
And information rights, really trying to keep trade secrets secret. And, I haven't seen a shareholder lawsuit. So the idea of the board is they're operating in the fiduciary duty of all shareholders, though they vote for their class, right? And having somebody who, if you take strategic money, their fiduciary duty is very much aligned with their company as well, not necessarily your interests. So I've seen that happen in one of the deals that I worked on, where it's just like, wow, that was like not in, like clearly in the strategic's best interest. So it's not, just go in eyes open. I think there's times where I've seen deals where it's like, boy, that's a great strategic, and they're putting a small enough check in because they just want to keep an eye on this innovation within the category. But it also depends on them, and make sure you've done your due diligence on the buyer and the investor and have called the other CEOs they've invested in and said, do you trust this group? Like, that's part of your role as a founder, is to say, you need to do due diligence. Is this going to be a good place for you to work? Or is your team going to love it? It's going to be a great culture. Those things matter because the team has been built around you as the founders. And the culture fit sometimes is, I've never stayed with any of the companies I've sold. So the 3 deals where I've been on the founder side, I've closed the deal and I've left. I know Mark has probably stayed, right? So it really depends on the person, right? But eyes open.
I agree with all your points that Dave and Mark made. I would just say, it can be transformative for a company to, strike up a strategic deal, especially if it's sort of the first major commercial deal a company is signing up to. And, the investment is, a strategic always wants to have a business relationship in addition to a financial investment. And so, and they often want some level of exclusivity. And so you want to try to limit that as much as you can, to have some, time period on the exclusivity, so that you're not foreclosing, a big segment of the market, and they aren't boxing out, competitors down the road. And you're not limiting your exit opportunities. Those are kind of the big things you want to try to avoid. And you have to kind of balance the good with the bad on those things, because it's a two-edged sword.
Yeah.
Yeah,
Other
love the
questions?
business
Go ahead.
development potential. So,
Other questions, you can come off mute and ask away, or you can type them into the chat window.
Dave, looks like there was one on protectable IP. Is that viable as an exit?
Oh, yeah. I'm sorry, I skipped over that one. So yeah, so the question was around protectable IP. Is its own consideration viable as an exit property? Ours is in a large market with deep IP. One of the challenges, I think, selling IP without the business to go with it is just a very difficult thing unless you've really wrapped it well with other intellectual property. But I have a lawyer on the call, so I'm going to let Gary address that one as well.
Yeah, I would say there are times where IP can be very valuable, and there are times where IP can almost be sort of an anchor around a company's neck, because it's expensive, and you end up spending a lot of money maintaining patents in a variety of jurisdictions around the world. So you have to kind of be strategic about it. But IP can be very valuable, and a lot of times the larger companies, are very interested in acquiring IP. It can also be a situation where, a big company is a little bit wary about it, because as a small company, you might not be subject to, a patent claim, but as soon as, a bigger company like Google or Facebook owns that IP, it might precipitate a claim. And so getting back to sort of the reps and warranties and escrows, those are issues that come up a lot of times in the discussions and negotiations. But IP can be valuable, or it could just be a cost center. So it depends on the nature of the IP and what sort of industry you're in. In life sciences and med tech, IP is almost required, whereas in IT, it's oftentimes not as important.
Yeah, speed and knowledge of the customer becomes the biggest variables for sure. All right, so I'm going to wrap up the poll here for a minute so you have a chance to do that. One other note just on the bottom there, OneHub is providing a 6-month free version of their data room. So if you need that, make sure you grab the promo code and the email, and they'll get you set up there. And then we will follow up with this again, and you'll get the slides and a copy of the recording or a link to the recording. So any other last questions there from the audience? If not, we'll get ready to wrap it up.
Dave, can I ask one more question?
Yeah, go for it.
I want to hog the floor here, but you talk about that you've had what you describe as 3 singles. We talked a lot here about founders having realistic expectations around valuation. One of the things that I've seen is most of the people talking about their exits and talking about their valuations are those who had those outsized returns, right?
Yep.
And so what do you recommend in terms of helping founders who may have unrealistic expectations, adjusting those? And are there people that that are talking about the singles, that are talking about the doubles, that are talking about the failures? I mean, how do we kind of make the narrative not so dependent on the survivorship bias of the outliers?
Yeah, for sure. I think one of the things as a founder I look at it is like, for me, it was a meaningful return. For my last investors in one of the deals, it was a 1.7x, right? But for me, it was meaningful. And I think as founders, one of the questions you have to ask is that back to the kind of very beginning of choose your own adventure. Like if you're growing at 40% a year with, profitability and your cash flow break even, and you're just crushing it, the answer is you can go raise 5 and exit 50, right? That's an option for you. If sales have flattened, or frankly, you've been pushing the ball uphill for 7 years and you're exhausted, the answer is it's not a bad outcome, right? And I'm not saying that you should, as a founder, forego the best returns for the investors, but when the market conditions change, or you pivoted, or you found that you have to do it, relaunch a new product. One of the boards I was on, the biggest transaction I was part of, we kind of had it was like, wow, to really redo this, we're going to have to like rebuild the senior team. and everybody kind of around the room in the boardroom was like, slump, right? And I think that's just it's a state of mind from the founders, because what you all have to face is, I got to keep grinding away on this. And at some point my spouse is like, can we buy a house? That would be really awesome. Because, we maxed out our credit cards to get this thing going. And then, I just lived in the trenches of this one. So it's very founder driven as well. And I think that I had Brad Feld on my board at one point, and he was like, if the founder wants to sell, it's time to sell. And not every VC feels that way, or investor feels that way, right? They need the one to return the outsized return. So got time for one more question?
Yeah, one quick comment. I'd say, for first-time founders, there can be times when they actually have a good product. It's a good market, but they're still having trouble getting funding. And part of it is they're not in the circle yet. They haven't had a success yet. And unless they're just killing it, it can be really challenging. So you've been in it for 3 to 4 years. You've got some traction. You either need to sell or get capital. At times, if you've got the right market you're in and you've done a good job with the technology, you can sell now, get a good exit. So let's say we'll call it a double for the investors, or a triple, and then exit. And now you have a win under your belt. You've got your own cash to help fund the next one. You've got investors that have been successful. And so now it makes the second one a lot easier. So that's just something to think about, why a lot of times that early exit kind of takes some of the pressure off. Instead of trying, I'm in this, for the next 10 years, let's go, okay, let's exit this one, correctly. And then we can go on to the next one. So.
And I'd say with that, you could come back and join eGen and AOA as an investor. And I think that would be awesome. So on that note, eGen and AOA members and team, thanks so much for the invitation to host. We'll make sure we get this out to you from a follow-up as well. And we'll be following up with it in email and the recorded message as well. All right, thanks everybody. And you can reach out to us directly if you have any questions.
Thank you.
Thanks, Dave. Thanks, Mark.
Bye.
We'll stay on for a couple minutes if anybody has questions.
Thanks.
I was wondering if you deal with earlier stage startups, ones without market presence or very small market presence?
We have, it's tougher to do valuations just because from a stage perspective. Mm-hmm. Do you guys have revenue already, or are you pre-revenue?
Pre-revenue. So I was thinking less in regards to an exit or acquisition, and more just like mentorship or guidance or.
Yeah, so there's some great resources in town. I sit on the WTIA, Washington Technology Industry Association. I'm the board chair for startup programs. So there's a startup cohort program. You can go to the WTIA startup programs. So just search for WTIA startup, and it'll give you a list of, we're trying to be the megaphone for all things startup in town, and where we can support different events. We're kind of agnostic about, we've kind of taken the approach to it of, if you knew the market the way I knew the market, or the way other serial founders knew the market in Seattle, you'd be like, avoid this group, do this thing, talk to AOA, don't talk to these folks until you're 50% funded, right? So trying to help, especially first-time founders, navigate the ecosystem in a way that you can do it in 6 months instead of 18 or 24 months. So that's really the resource there. So definitely go to WTA Startups, sign up for that list, and that'll give you a good place to start.
Awesome. I certainly will do that. Great presentation. Very well coordinated. Thank you so much.
Yeah, you bet. Thanks, Paul.
I'll probably follow up with an email or something.
No worries. Drop us a note. Happy to do it.
Thank you so much, guys.
Thanks.
Okay.
All right. So anybody else have a question as we're dwindling down? The count's going down.
Is David still have the question around IP leak?